Good morning, everybody. I'm delighted to be first up this time, which is the first time in a long time. And I can only hope it's because there's a little more interest in our domestic equity market, or in equities in general, which, given a few charts that I'm going to show you a bit later, I'd certainly like to believe is the case. The title of the presentation, though, is It's Been a Very Volatile Year, It's Been a Tricky Year, It's Been a Hard Year in equities so far. And my question is, despite the valuations, is there more trouble on the way? Or as my Afrikaans colleagues would suggest, is the second acronym lower down on the title page, which many of you will know immediately what that stands for. So let's have a quick look at a review of the last couple of years. On this chart, it's simply the domestic equity market, our all-share index, and you can see there back in Q1 of 2020, the big hit caused by the shock of the COVID pandemic and the lockdowns we experienced, the substantial recovery and the great run that we had since then. On average for 2021, that's that first horizontal red line, you can see the market pretty much moving sideways, strong into the end of last year, and a fairly strong start to Q1 of this year, shown by that first bar, but then the substantial drawdown we've seen subsequently. Our domestic market down a little over 10% in Q2, and about a further 2.5% in Q3 has left us down on a year-to-date basis. And obviously we're looking into Q4 to say, what does that hold as we run into the end of the year, given the weak period that we've had and the volatile period that we've had. You'll also be aware that we've been relatively isolated here in South Africa, that despite the weakness we've had here in Rand, relative to global markets, we've actually done a lot better. Some of the highlights of things that's captivated the market's attention and investors' attention during the course of this year, which I'm sure you're familiar with, but just to put a few pictures in place to remind you, the first is this massive spike in inflation. That's South African, American, and English inflation. The first chart on the left-hand side. Miraculously, for the first time, certainly in my memory, it's interesting to note that South African inflation is lower than it is in both of those countries, with us, our economy being relatively protected in comparison to those from inflationary effects. The tremendous response that monetary authorities have mounted in attempts to suppress inflation, which is obviously an intensely watched, closely watched factor. You can see this chart in the middle shows the number of central banks that are raising interest rates at the moment, and you can see over a very long period of time that's at a very high level. And of course, this suppressive monetary policy is impacting on growth expectations, together with constrained consumer wallets in the face of inflationary pressures, whether it's coming from food or energy or gas prices or rent and shelter costs. This is having a negative impact on economic growth. And the chart on the right just shows, as a simple sort of demonstration, the IMF's expectations for world GDP, and how those have been revised down consistently on a quarter-by-quarter basis throughout the course of 2022. So higher inflation, higher interest rates, leading to lower growth across those sort of broad economic factors. And then, of course, overlaying all of that, there's this constant threat of heightened geopolitical tension and the war in the Ukraine, which is dragging along, and now, more worryingly, in the east, of more noise from North Korea, as well as this sort of, almost tangible threat from China as relations there are deteriorating to try and do something more aggressive with respect to Taiwan. This is just a great chart that shows you how much of a derating that we have had. The first point I want to make on the left-hand chart is just look how cheap South Africa is. Our market, which hasn't done very much for the last 6 or 7 years, has been in a constant period of derating. And you can see we're now at less than 10 times earnings, which if you look back over a long period of time, is at extremely low levels. In fact, we're trading at levels that previously we would only reach, or troughs we would only reach during periods of a massive market collapse. We haven't had that. Valuation, I believe, is incredibly attractive. Combined with that, we've also seen other EMs In the case of China and Russia, some fairly dramatic events, but across EMs have also derated. That's the grey line in the middle. And then we've seen a substantial derating of developed markets, which don't look quite as cheap on an absolute and relative to their history basis, but are moving back into a better territory. And the chart on the right is a fascinating one, which breaks up the move on a year-to-date basis and looking back over many years, where the red line is the rating, derating or re-rating if it's positive, and the blue block is the contribution of earnings. And if you look there on the last point on the right-hand side, you'll notice we've never had as big a derating in the US market as we've had so far year to date, combined with actually earnings growth, which has meant that the extent of the derating has been very severe. Of course, this is the next chart that explains that is if you look at how far apparently analysts are behind the curve. So what you see here is the yellow line is the PE multiple of the S&P 500. Again, you can see that derating that we've had. The pink line is just the index itself, about 27, 28% off its peak of late last year, but the white line shows the earnings expectations of analysts, or the consensus expectations. And you can see the market has moved well ahead of the anticipated substantial decline in earnings. This seems entirely likely, and we would expect that white line to roll over quite dramatically. But the real question to ask yourself now is the extent to which the market has already discounted that or not. Are we in for more trouble, and the market, there's still more to come? Or has the market fully discounted the decline in earnings in the US that it certainly seems to be anticipating? Turning to South Africa, here we go again. Groundhog Day as usual. We live in a country where we have a failed state. Almost every day you can pick up a newspaper and find another piece of evidence to support that. The medium-term budget policy statement yesterday didn't contain anything of any surprise. In fact, to me, it looked just like the finance minister kicking the can a little bit further down the road. Some marginal, aspects of glimmers of hope around something a little bit more constructive with respect to SANRAL, but essentially Groundhog Day. A couple of charts here to illustrate that. The two bottom charts are business confidence and consumer confidence, which have suffered from decades of decline. Really an appalling indictment of the ability of policymakers to engender confidence in either consumers or business managers. Of course, it's very hard to grow an economy that doesn't have power. And that's the chart on the top is the energy availability or electricity availability factor going back 3 or 4 years. The bottom line that you see is 2022 year to date. You can see 2022 represents a record poor year of performance from Eskom on the back of a very poor performance over several years. But thank goodness now we have the substantial removal of restrictions of self-generation limits. And so that is a glimmer of hope that with that, let the private sector in, and the private sector will solve many of the problems that exist. And that realization, as difficult it is for an ANC government with a high number of communists sitting in its ranks, is an inevitability that is in all our interests, I certainly believe. Unfortunately, putting all of this together, although GDP, the chart on the top left-hand side, has recovered quite nicely from the impact of COVID, and then with a few own goals scored with respect to something like the riots in KZN, if you looked at the expectations from the MTBPS yesterday, there's growth, but very unexciting. We should be doing so much better, and we could be doing so much better. Despite all of that Groundhog Day evidence, there are also glimmers of hope. And it's important not to look at the world through rose-tinted glasses, but equally guard against being too cynical. I think vehicle numbers, which is the first chart on the left-hand side, demonstrate a very encouraging move. We've had the benefit in the chart in the middle of high commodity prices, which have supported the current account balance and the trade balance. And despite the fact that those have rolled over from very high levels, are still making a very positive contribution. And then tax receipts have been surprisingly strong across the board, which is the chart on the right-hand side, which is the year-on-year growth in personal income tax, the first one on the left-hand side. Then, no, that's corporate income tax is the first one, growing at 37% despite lower commodity prices. Personal income tax growing at low double digits, VAT receipts at 27%, and property tax off an extremely low base also running very well. And those were the positive surprises that we saw in the MTBPS again yesterday around tax receipts. There's extreme value reflected here with the JSE forward PE index of 8.5 times, but I question whether anyone cares. This is a massive bugbear for me personally, traveling around the country. There just seems absolutely no interest in South African equity, either from domestic investors who only seem interested in taking their money offshore, certainly institutional investors with the relaxation of Reg 28 to the 45% level. We calculate that's about another 1.2 trillion rand that will leave the country, and all of it will go offshore to be managed internationally. None of it's likely to be managed here by domestic managers, regardless of how hard we've worked to build a track record in that regard. And the foreigners, the chart on the top right, continue to sell our market. That's cumulative net outflows from the JSE going back to 2018, with dual listeds on the brown line and domestics on the blue line, both of them in decline. There seems no interest from foreign investors or emerging market funds equally under pressure to buy domestic equity. Faced with those headwinds, I pose the question, is there more trouble to come, or HKNK? The rand has been weak against the dollar, but less so against many of our other trading currencies, clearly indicating the mighty dollar on the left-hand side, its appreciation relative to on a trade-weighted basis. And you can see the chart on the right, how it seems to have moved off into its own kind of stratospheric point. What's that meant from a Rainmaker perspective is that with the further relaxation of Reg 28, we have not taken any more funds offshore. We think we've got more than sufficient already in rand hedge stocks. You can see if you include the domestic rand hedges and the basic materials or the mining stocks, which are essentially rand hedges, about 60% of the fund is already offshore, we would say. And of that, about 27% is in direct foreign equity. So we're not looking to do any more as far as that's concerned, especially because we think there's tremendous value here in our domestic market. With the currency having blown out to the dollar as far as it has, we have in fact been hedging that dollar currency. While we keep the underlying investments, we're starting to hedge some of the currency back into rands because we think it's gone too far. And there's some very interesting instruments that we're using, picking up some great lessons from my colleagues in the multi-asset space. We've got some really interesting instruments in the portfolio, and the auto call position in the portfolio is now up to about 3% in total across a wide variety of underlying instruments. And we've trimmed some of the smaller international holdings. I've listed the top 10 or 12 companies, I think, on the right-hand side. Very pleasing to see some of our global picks making it up into that top list. And we're very confident about those. We've also found some great mid-caps that are graduating out of entrepreneur into Rainmaker, and we expect to find even more given where current valuations are. That's all I have for today. Thanks for your interest, and hope it's as clear to you as it is to us that domestic equity is certainly looking like a really interesting space at the moment. With that, I'm going to hand over to my colleague from the bomb squad, Omri Thomas, to take you through opportunity.